What is the financial and economic cost of this drama that has unfolded with the AstraZeneca vaccine?
Yeah, it's a good question, isn't it? Well, I mean, I guess it's more delays, it's more lockdowns, it's more stimulus that's required, and more government debt, I suppose, to cover all those issues, whether it's furlough or whatever. So, yeah, it's not great, is it? It's not the most impressive logistical exercise. And I guess the other issue, perhaps more peripheral and longer term, is raising that sort of nationalistic type language again, type rhetoric we're seeing out of the Commission. Obviously, with Brexit, you've had bits of that over in the UK for several years now. So you bring all that together, it doesn't help the relationship going forward and adds to friction and therefore probably inflation on the margin. But the reality is it's primarily just a timing issue. I don't think this thing's going to cause too many major problems as long as people get vaccinated and life unlocks, economies unlock, and people get back to normal.
It is going to have a big economic impact, as you say, though, in the near term. The US is powering ahead. You've got fiscal policy, monetary policy, a vaccine rollout that is working, all leaning into the United States and making it kind of advance at a much faster rate than what it was seeing here in Europe. Yet, Chris, the equity markets, you look at the kind of performance year to date, S&P is up by like 5%, the CAC 40's up by 9%. You're not seeing much divergence in terms of equity market performance. Why not? Do you think that equity market performance starts to change?
No, I don't really. I think basically the primary driver of global equity markets at the moment is this sort of value versus growth on the very big picture scale. So, and of course, the American market is about 50% growth stocks in terms of its market cap, if you look at the S&P 500. Whereas you look in Europe, and some of those markets have barely got a few percent in terms of growth within their market sector composition. And their European markets are much more about value, about global reflation. A lot of the global companies, they're global industrials or the Eurozone banks that are keyed into the global bond yield. And of course, where US 10-year yields go, so directionally do bond yields go, and French yields and gilt yields and so on. So really the European outperforming story is much more about the global bond yield story, the growth stocks underperforming in the States and the sector weightings than it is about the Eurozone economy versus the US economy. It's much more geared to that sort of story, I think. And therefore, you know, in this sense, the lockdowns aren't that important in terms of bond yields globally and in terms of relative sector performance. I don't think it's the big issue.
But that feeds through to the stimulus conversation, and the U.S. is trouncing Europe on that, to Guy's point. And I want to bring in what Peter Kazimir, the Slovakian central bank governor, said. He said, "My concern is that compared with the enormous U.S. fiscal impulse, the effects of the European one will kick in with a major delay. We're talking months and years, and the fiscal reaction is really lagging behind, and it needs to pick up." How do you see that unfolding?
Well, that's a fair point. But the reality is the Eurozone economy for the last 15, 20 years has always followed where the US and China have gone. So if the US and China are starting to motor, once the Eurozone starts to unlock, and once it gets vaccinated, it'll follow that trend. I mean, the best correlation for Eurozone growth outlook is global trade outlook. And actually, one of the big drivers of global trade is the US consumer. And to my mind, the US consumer is waking up, he's alive and well, and he's going to spending a lot of money for several years. And that's going to drive a lot of global trade growth and export growth. And obviously, the likes of Germany, where 50% of GDP is exports, it's a very big beneficiary. So yes, the recovery is stalled by this sort of renewed lockdown momentum in France and so on in Europe. But the reality is it'll come back and it'll follow the most important stimulus in the world, which is the US fiscal and monetary stimulus. And yeah, it's aided and abetted by their own fiscal plan in Europe. But that's kind of secondary, really, to the global winds that drive the Eurozone economy in normal times.
Chris, today's all about the Fed. And I'm fascinated to see what it has to say for itself a little bit later on. That J-Powell press conference is absolutely a must-watch event. If the Fed signals that it is going to be starting to raise rates in 2023, what impact do you think that's going to have on European government bonds? Treasuries are already shooting higher. We're going to see an impact in Europe. My question to you is, can Europe afford that reaction? If, for instance, BTPs start moving up, is that going to be an issue?
Well, that's a great question. I mean, first and foremost, I'd say I don't think they're going to signal that, but they may do. You never know. That everything's on the table in that sense. But I think if they did signal it, what you'd see is a temporary short-term flattening of the curve. So short-dated yields up a bit and longer-dated actually off a bit. So the implication for BTPs would be the similar kind of trade. I think the yields would actually fall slightly from where they are at the moment. So, I don't think it's going to happen. But if it did, I think that's the main implication, rather than yields taking off to the moon on the 10-year because suddenly they're signaling we're going to raise rates in a steady basis. I don't think that's a credible thing to expect at the moment, given where the global economy is. And so I think that yield back up at the 10-year aggressively on that announcement wouldn't happen. And I don't think the announcement will happen anyway.
But flip it. If they say nothing and they don't get in the way of higher yields, what's going to the moon?
I think yields are ready to stabilize. I think the bonds are deeply oversold on price. They're as oversold as they were in late 2016, early 2017. They're as oversold as they were during the taper tantrum in 2013. And after those events, what happened is the price basically stabilized, the yield stabilized, or even the yield softened a bit. So, and actually, if you look at the housing market in the US, it looks like it's just softening, coming off the top a little bit, and the bond market regulates growth. In normal times, yields back up, growth slows a little bit, yields soften, and then growth reaccelerates several months down the line. So, I personally don't think Jerome Powell needs to say anything to try and control those yields. I think they're going to control themselves, and I suspect they'll soften a little bit over coming months, contrary to popular chatter.